The Hedgeless Horseman here. It's January the 6th, 2023. I'm just going to talk a bit about, uh, let's say, knowing the game or your game or knowing what your thesis is. And in my opinion, know how to block out noise or identify what is noise at least. So, okay, Magna has obviously been one of the best performing stocks lately, for very good reason. I mean, last example is yesterday when they put out one of the best nickel intercepts that any junior has drilled over the last 12 months. Uh, but as always, everybody is short term focused. The main goal of, even though they don't think that's their goal, the main goal is that everybody wants to make money all the time, every day, every week, every month, every year, but specifically every day. And almost everybody's a short term trader, for lack of a better word. Uh, and I think Magna is just one of those stories that is a perfect example of how we tend to operate. So, first of all, what is the actual case in Magna? Is the case that I think Magna will be up tomorrow or next week? That is not my case. I have absolutely no idea where Magna is going to trade today, tomorrow, next week, next month, 2 months from now, 3 months from now, etc., etc. Uh, my case for Magna is that I think that it should already be, I think fair value, which is going to act like a magnet in my opinion, is at least somewhere around here, just based on what is now known and confirmed right now. Right now, that might be a low ball. I don't know. Maybe this is low ball. I mean, if you compare Magna to its peers, it's very cheap right now. And given that one of the main attractions of Magna, one of the main value drivers, is the quality of the team, their ability to create value over time, which they've shown in FNX Mining and which they've shown in Magna, which they've shown when they picked up the Green Hill mine, which they've shown when they got hits like this we saw recently. I mean, first hole they drilled was on the top list of nickel intercepts in Q4. First hole, second highest grade. This hole, the second hole was even better. You know, you can't ask. I mean, those are barn burner holes pretty much, and I mean that kind of stuff is gonna or should put out some serious cash flow if that got into production, and it's quite near surface, etc. So it's not like in 15 years from now they might be able to mine that. No, mineralization starts near surface or pretty much at surface. So again, what is the actual case for Magna? My case is I think that uh, the more, the longer I hold this stock, the more value will have been created. Uh, Under that assumption, I expect to have a better return the longer I hold Magna, because that is the only way to capture the alpha of a superior management team, of a good and great team of value creators. If I give them 1 day, they will not have a chance to create much value. If I give them 1 year, they probably will have created a lot of value, and I expect to be up, you know, have a positive return. If I give them 2 years, I expect them to have created even more value, and 3 years, and so on and so on. So if the case is that right now it's worth maybe at least somewhere around here, which is already a nice price to value gap, especially given the risk nature, etc. It's not some tangible, uh, you know, uh, probability based thing. No, we know they have 50 million tons across two deposits that are very advanced, pretty much fully permitted, uh, in Sudbury of all places. The CEO owns a lot of the shares, and he has been part of a major success in Sudbury before, which ended up being over $1 billion success. So he has more reasons than anyone else to create value because he has more at stake than anyone else. So if you think you're working hard just looking at the ticker all day, you can bet your ass that Jason Jessup, who is the CEO, is working even more and not looking at the ticker but creating value. So just based on some common sense for a superior management team, especially if they have starting off with a great asset with exploration potential, the base case scenario is that the longer I hold a stock, the more value will have been created. And if I sell it today, buy it in a year from now, I assume a lot of value has been created. But I'm probably going to miss the actual revaluation because I'm probably going to pay a higher price. So the only way to capture that alpha is obviously to hold it from today to a point where much more value has been created, which again I expect to be in an upward trend. So from now until 1 year, I expect X amount of value to have been created, and I expect that to be reflected in an increased share price. 2 years, I would expect that gap, the current price to future value and future price, to be even higher. And so if time is on my side, meaning that the probability that I will have made money and the amount of the money I will have made will have gone up the longer I hold it, obviously holding it for a long period of time becomes the best predictor of returns. And if you're starting off with it being undervalued already, one could say you have a free risk adjusted lunch, which might be anywhere from 60% to 120%, which is, again, the market average is 8 to 9% per year. So that's a few years, several years worth of typical stock market returns, just based on where we are at, perhaps right now. And I might be off on that. I certainly do not think this is aggressive. I think this is quite conservative. Again, if you just compare it to other nickel juniors, and especially the advanced stage of these projects, we might have been a toll milling scenario within 12 months. Given where nickel is trading and PGMs, etc., that could throw off a lot of cash flow, and it could be become self-funded or almost self-funded. Then we have all other upside surprises to keep in mind, because again, the 50 million tons that are there are not going anywhere, and they've already shown that they can fill in gaps, etc., in mineralization. And obviously, again, the recent hit was an absolute barn burner. That the margins on that ore probably very, very high, very, very valuable ore. And then we have things like, okay, in 3 months or so, we'll have a PEA study out. Okay, what's that going to show? If they use today's nickel price, I think Green Hill is going to look incredibly valuable with very high IRR. If we end up getting a grant for, say, $100 million, the IRR would be obscene. If we do end up getting a grant and get half the capex funded to create a hub and spoke model of 2 mines, the IRR would probably be insane. Will they have even better margins than if we use toll milling? And the cash flow, again, you can read in the forum some, spreadsheets of how that might look. It will make Magna Mining incredibly cheap today, based on that, and with 50 million tons, which I expect to grow obviously. So we see here constant drilling results expected from early 2023. So they're not, again, this is value creation. Given the team that's involved, old FNX team, they made several discoveries, put several mines into production. I think they even put one mine into production. I don't know if they had a PFS or if they didn't have a PFS. Anyway, they were able to put mines into production without feasibility studies at least and make it a success. So they have a history of being good operators, and Jason Jessup, the CEO, oversaw I think it was the manager of some of the mines. So they have that box ticked, actual production. They have the exploration box ticked because not only were FNX Mining famous for building a success out of toll milling alone and bringing mines into production via toll milling, they were very famous for being the most aggressive exploration team in the Sudbury area, with multiple discoveries and including footwall type discoveries, which they are, as they say, are focused on both resource expansion and potential for new Sudbury footwall discovery. A new Sudbury footwall discovery would be a game changer pretty much, because as Jason has said, that's some of the highest grade ore in the world. You don't need a lot of that to be worth a lot. Same as, Fosterville, for example, wasn't the biggest gold mine in the world, but it was such high grade that it still was worth billions. I mean, there's 3 million ounce deposits out there that are almost worth nothing, while Fosterville's 3 million ounces, for example, in and around the Swan Zone was worth billions, simply because of the margins. So very asymmetrical payoff for the amount of tons and ounces. So this is a potential game changer. They're going to grow both resource expansion because they have many zones that they are going to be flushing out. I mean, these are the footwall, 3 footwall potential areas. So those can be game changers. They have a lot of areas to just expand on the current resource, expansion potential here, and you can see the nickel equivalent grades. I mean, these are a lot of pink hits. That's about 2% nickel excuse me. Here you can see obviously gaps, etc. So I expect, if we fast forward, in a year, I think they will not have 50 million tons of resources. I think they will have quite a bit more than 50 million tons. So that's put upwards pressure on the valuation because that's creating value. They might be in production, and even given the some of the grades, you don't need a lot of tons per day to have meaningful cash flow for a company the size of Magna, or I shouldn't say meaningful, significant even cash flow. And if you have that much in terms of resources, that alone could throw off money for a long time. And then you also have, obviously, I mean, they're going to be drilling at Shakespeare as well. That's a big area left to explore because that's a pretty big land package. 3,000 to 5,000 meters of drilling is planned at Shakespeare. Fill gaps, etc. So I expect Shakespeare to grow as well. And the thing about, I'm just going to see here, this is the Shakespeare project. Here is the Shakespeare deposit. This deposit alone at $22,000 nickel, I think nickel today is around 29,000, at $22,000 nickel. As you know, Mitsui suggested, and I think Magna felt that was a lowball valuation. Anyway, at lower nickel prices, Mitsui suggested that Shakespeare alone, just the deposit, not this land package, and certainly not Green Hill Mine, just the deposit alone was worth somewhere around $64 to $100 million at a much lower nickel price. So one would naturally ask oneself, what is that worth alone? Alone, just this, not the land package, not Green Hill, today at higher nickel prices. Certainly above 64 to $100 million, right? Uh, I mean, if nickel prices are up 30%, you can just imagine how much that would show up in margins, for example. So who knows? Maybe, I'm just guessing here, at least 100 to 150 million for the Shakespeare deposit alone, potentially at these nickel prices. Oh, okay, that's probably lowballing it also because uh, uh, but I digress. Let's just try to be a bit conservative. That's pretty much in the ballpark of the current market cap for which is supposed to reflect not only the Shakespeare deposit, the Shakespeare land package, and the Green Hill mine, which looks to be at least twice as good as the current Shakespeare deposit, uh, highlighted by the recent drill intercepts. So is Magna cheap or expensive right now? I'm very comfortable saying that Magna Mining is still very much undervalued. So what is the case? Case is again that I think at least Magna Mining is worth somewhere around here right now. How do you take advantage of something beyond being undervalued? That's buying it when it is undervalued and waiting for it to be fairly valued, because the market has a tendency, like Warren Buffett says, in the short term the market is a voting machine, over the long term a weighing machine. So from the get-go, my expectations are that I will at least have, let's say, a 22%, 82% expected return from the current share price. And with the addition, the longer I hold it, value is going to actually go up. So maybe with the recent results, maybe fair value is actually up here instead. So that's 100% expected return, which is again my goal is to have around 50% return per year. I think Magna can easily surpass that over the coming year, which would make me very happy. And I'm looking for high probability returns. I mean, if I can find a high probability double, that's worth way more than I mean, let's take a pre-discovery play where you have a less than a 5% chance of making a discovery, and after the discovery, the actual payoff uh, on the first day might be 100%. So you're taking 95% chance of failure to get a double. That is atrocious risk reward. Finding something that is significantly de-risked in the hands of uh, major value creators with a positive correlation between time and value, that is, those are my dream cases pretty much. So let's say if the share price would have stayed fixed here for 6 months, whatever, up until here, for whatever reason, I think fair value might be up here. So even though I didn't get any returns in the short term, my future expected returns are even higher. So I would want to have more here at the same price than here, because time has passed and value has been created. But obviously, it's like now, for example, people message me, and I guess people are fairly aware that they did a financing, 20 million financing, mostly done by smart money, long-term smart money. That private placement gets free trading at January 28th. And that's what a lot of people are focused on right now, for example. Why? Does it has anything to do with the value of the company? No. Could it impact price in the short term? Yes. And again, that is the focus of everybody and their mother. if there's a risk, upside risk, everybody wants to be in short term. If there's downside risk, everybody wants to be out. But when you think about it, like my case has been the same since I uh, plowed into Magna, and I think I bought not much, but I added a bit on the news release yesterday because I couldn't believe my eyes that the market didn't respond immediately. Uh, I've been banging my head against the wall basically last 2 months because I didn't want to believe that a market could be this stupid as it has been with Magna. But the irony is that unless the market was as short-sighted and stupid as I believe it is, there's no way you could beat it. If I mean, complaining about the market being irrational and short-sighted is basically complaining about uh, being offered opportunities to have good returns. So you can't have it both ways. I mean, in an ideal scenario, it's pretty much if we're right. I mean, to me, Magna should already be up here, at least, let's say. It isn't. Okay, is that frustrating? One From one angle, sure. From one angle, not. If it was fairly valued already, the opportunity would be gone. Without an irrational short-sighted market, there would be no opportunity. Without these profit-taking events, for example, you wouldn't get the opportunity to have even better returns, let's say. But I haven't traded Magna at all so far. I've just sat on my position because I think there's still risk-adjusted money on the table. But typically everybody cries at every short-term profit-taking event, for example. It doesn't really matter. I mean, if we're gonna go here or whatever, uh, is a requirement that you will never have any weeks of down action or something? No, I mean the whole case is that I think I'll get let's say 100% from here. If that looks like this or this, it doesn't have a big impact, but sure it will feel different on the way up, let's say, because I couldn't believe that it actually had profit taking here or here. That doesn't stop people from taking profit. And it's like, take this, okay, free shares come trading January 28th. What does that mean? There might be profit taking. In a totally rational market, we would already be up here, in my opinion, and the shares that come free trading would immediately be bought by somebody who said, hey, okay, it's maybe trading at fair value right now, but I think it will have a positive expected return. I mean, in reality, when you account actually for the value creation, fair value should reflect that. So it's kind of wrong of me to actually say that fair value is here, because that's just based on, let's say, how Magna looks right now. But an investment should account for not only how a company looks like right now, obviously, but all future potential. So when we account for the fact that value should be probably created, and let's say if we assume that, hey, Magna's value is going to be at 4.34, let's say in a year, that should be back discounted to whatever discount rate you would want to have. It's like, okay, if that's the case, that's an expected return of from today of like 45%. That's very good returns. So maybe fair value should actually be at $3, for example. Because it should account. This is maybe, I mean, again, the market average is 8 to 9%. This is obviously way more than that in this scenario, but it's riskier than the overall market, etc. But who knows? It's like, what we know is that Jason's pretty much stated that he's not gonna take. He will allow himself to take some money, first money off the table after they've hit $1 billion in market cap for Magna. Uh, if you use a fully diluted share count right now, based on the current share structure, that's around, I think it was, what was it, like $5.15 per share. From today, that means that from here to Jason's pledge, where he will allow himself to take money off the table, that's still a 400% upside left, which is obviously massive, absolutely massive. Given that he said that's when I can allow myself first to take profit, it sounds like he doesn't think that's like a 20% chance of happening. And that's again first profit, and he wants to build a mid-tier nickel producer. So who knows what that would be? I mean, maybe he takes some money off the table because he has like 99% of his net worth invested all the way up here. But I guess the point is that I think price to value, the price to current value gap, which I think actually is higher than here if you account for the possibility of grants, the expected value creation, potential of toll milling, all future potential, etc., footwall discoveries. I think it should obviously be higher than just what they have right now, because it's a good probability that they will create a lot more value, and that should be reflected at price today at any given point. It should be the discounted, risk-adjusted fair value for all that Magna can be, obviously. So this is from that standpoint, this is a low ball thing. It's just based on the 50 million tons they have now and assumes no real exploration potential, let's say. So maybe it's actually higher. So that's in that case, that's what I'm playing for. Let's say I'm playing for at least 120% of like low risk returns, let's say in Magna, if you can call it that. Under the assumption that yes, the market at some point the market will close the price to value gap. And I don't know too many stories that are like for sure 50% undervalued, almost based just on what is already confirmed. That is why I think even after the run up, the price hasn't gone high enough for this to be a poor price to value gap. I'm gonna be very happy if I can get 100% return within 12 months and see this gap close. I think that has a higher likelihood of happening than in most juniors I know. Again, based on a risk-reward perspective. In the meantime, we will have ups and downs, etc. But all that is changing volatility-wise for me is that, okay, at $1.10 might be 110% I expect to get from that point on. If price goes down in the short term, like now it's at, I don't know, 1.04, that means I have 120% of future returns. They're not, they're not short-term corrections. They don't destroy value. It's like up here, for example, if you bought here, you got 96%. You still got 96% even though it retraced first. And you actually got a chance to add. And I added in every correction so far pretty much. Same here. Here you still got your 48%, even though it went down, I don't know, 20% first. You think I'm complaining right now because it didn't go straight up? No. Will I be happy with, let's say, a quote, easy 100% return from here? And the trade-off would, or the trade-off, not even a trade-off, but I still had to sit through, short-term dips? Absolutely not. So let's say free shares come, free trading at January 28th. Let's say price goes down. Is that a problem? Why would it be a problem? Did something change with the value? No. Did price to price to value change? Maybe. Is the if I bought here and it went down, does that mean I'm not going to get my 108%? No, it just means that might, get the opportunity to add with a 121% expected return as well. But everybody wants to trade these. I don't get it. I do not get it. The whole case is that it's cheap with a very good expected return and an even higher expected return the more time passes. That's the case. That's the pledge. It's not based on. I have no idea what the price to value gap is. I don't even care about the value creation portion. I just want to trade this stock. I mean, then you can go and trade some crap company instead. You're literally squandering the whole point of a story being undervalued in the hands of a successful value creation team, a team of value creators. I mean, seriously, that's how I look at it, at least. I mean, this is not a trading sardine. A trading sardine is typically, I mean, the whole idea is that, hey, they don't really create any money. If you give them time enough, they're going to destroy value. So the only thing you can do is try to trade the volatility. An undervalued case means that sooner or later, I expect the price to value gap to close. Since I can't know when that's going to happen, all I can do is sit until it closes. And if they are value creators as well, that means I'll get paid to wait. Because if it takes 6 months for the price to value gap to close, based on what the price to value gap is right now, if that takes 6 months, that means value is probably going to be higher. So the gap is actually going to be even wider to close, which means that I expect to have, there's going to be even more pressures to the upside. And in that case, let's say the fair value is here right now. Maybe we go up 74%, whatever, in 6 months, but maybe the value is actually up here by then. That means that after you get your 72% return, there's still 62% left, etc. And if they keep on creating value, maybe you get to close what the value was back here, but 6 months have passed, so after you get another 62% return, there's still a 41% price to value gap that's in store for you. That's how you get multi-baggers, pretty much. You have to give it time for value to create, the price to value gaps to close, etc. continuously. It's not like they're going to create a 10-bagger in terms of value addition in a day. Think of it as like, yeah, if they create 50% extra value every year from now over the next 5 years, that means my expected returns are 50% every year. And sooner or later, that's going to be a multi-bagger. And if all things go well, will eventually reach a 10-bagger, etc. But the only way to capture that if you hold it for when the price to value gap is, not closed, and wait for it to close, and then value will have ramped up. So you have a new price to value gap to sit and wait and close. And the time you would sell would be like, if it actually gets to fair value, and especially if they mature, there's no growth to be had, let's say. So yeah, I mean, I guess this is a long rant about, like, in my opinion, if a major driver for your case on a company that is cheap, the whole way to play that is to wait for the price to value gap to close. If you're just trying to trade every movement, because most people are very bad at trading, at least I am, you're basically not even taking advantage of what the opportunity is. It's like, okay, like saying, hey, I think I'm going to get 100% return in this stock. It's just a matter of when, but I'm going to try to trade it. So you're saying 100% is not good enough for me. I'm going to try to get 120%. You're probably just going to end up buying high and selling low, of course. And let's say the January 28th comes, and everybody expects, hey, I expect there to be a lot of shares to that for a short period of time will dampen the stock action, let's say. That's still just a short-term money flow or flow of funds hurdle, because at some point they're going to be out of shares anyway. And maybe, shorts going up recently, maybe that's people from the private placement locking in their gains. So they've already perhaps sold some of the shares that they were going to sell. So when the actual free trading, that point in time comes, maybe they've give the shorters or the one they borrowed stock from to short, they'll give them their private placement shorts, and maybe there won't be much in terms of free shares sell pressure. I don't know that. I just know what I think the price to value gap is. So as long as this is not closed, I'm not, in my opinion, gonna be stupid enough to try to trade every bottom or top, because then I will completely miss what the whole opportunity is about. And I can't predict when the revalue. I mean, people have been screaming tops all the way up. And before the news, for example, people were in the forum saying, hey, it's going to go down to 70 cents. Well, it went up to what? 1.10. So like if you want to trade an alpha story that is already starting off undervalued and think that the way to take advantage of the fact that the price to value gap is pretty wide and they are, expected to create even more value the more time you give them, so the price to value gap widens. If your way of playing that is to be a short-term technical trader, etc., I don't know why you even bother with an alpha case. You can trade Bear Creek Mining or some other trading sardine in that case, because there's no opportunity cost to time. You don't even catch the alpha of a value creating team, which is time, because you're only looking at the short term and like, yeah, I'm in for 2 days and then I'm out and whatever. That makes absolutely no sense to me, at least. And with that said, it's like I have absolutely no idea. Maybe Magna will trade at 90 cents next week. Maybe it will. The market will figure out how cheap this is, and it'll trade at 130. I have absolutely no idea. So far, I bet I made more money than all traders in this stock, at least. And to me, this playbook remains the same. I'll hold this to. Well, I can't guarantee I'll hold everything. I mean, I have an obscene position already. But the idea is that an undervalued stock, the play is to hold it until it's not undervalued anymore. If you're a trader, you don't care about undervaluation really. If it's a value creating team as well, that means the longer you hold that stock, the higher the odds are that you'll actually make money on that stock and make more money on that stock. If you hold it for 1 year, they've created X amount of value. If you hold it for 2 years, maybe they'll created 2x value. So if you pay Y today, and it's probably worth X tomorrow, which might be 100% higher, maybe that's going to be 100% higher than that in 2 years. We're front running a future, and the only thing we can control is what price we pay today in an unknowable future. Anyway, I hope some of this stuff made sense. But if there's something I will leave you with, like consider what is the opportunity, and what is the common sense way to play an opportunity. If it's cheap, it means there's a difference between price and value, and your base case is that that gap will close someday. If there are a bunch of value creators, your assumption should be that they're going to create more value as time goes by. The longer you hold the stock, or the longer time passes, the more value will have been created. And the only way to capture that, if you're in before all that value was created, unless you're basically hoping that, hey, they're going to create 200% of value over the next, let's say, 2 year, and I'm going to hope that price will be unchanged and nobody has figured that out, and then I can buy it 2 years later and it's going to go straight up. I mean, obviously that's not the case. You see this stuff here. This should be way higher already. It shouldn't have opened up here, for example. It should have opened up here, or maybe actually here. That didn't happen. That's how markets work. People take profits, yada yada yada, and almost everybody, almost nobody beats the market, and that's good. We want people to be irrational. We want people to be short-sighted. We want people to take profits when they, in my opinion, shouldn't. We want people not to think they need to chase. I'm not going to chase. Because they're looking at what's happened. They're not looking at the price to value. They look at what they missed and think, no point getting in now. Remember that. Almost nobody beats the market. Almost nobody beats the market. Because everybody is short-term focused. Everybody's main mission is to never sit in the red. That's why they sell every low, because if they had to bet, they would expect the price to go lower. That's also why they buy high, expecting price to go higher. When it goes down, they sell instead, because now all of a sudden they think the price is going to go lower. They don't see the big picture, and it's like, yeah, okay. I mean, theoretically, if I were to take the Jason pledge, like, okay, I'm not gonna take profits until Jason takes profits. In that case, that would be, kick up your feet and relax. Either Jason will it to existence, make Magna into a 1 billion company or more. In that case, I could probably retire with my Magna stake alone. That's, in my opinion, what's at stake here. I think we should be already up here easily. I think there's a fair shot that Jason actually makes this into a $1 billion company. Or more, obviously. If they had another mine, etc., etc. But my bet is they will keep on creating more value. So the longer I hold it, the bigger the odds are that I will be in the green. That is not the same for a trading sardine. A trading sardine is that the longer you hold it, the bigger the chance is that you're actually going to be in the red. Totally different things, totally different ways to play a stock or a story. Again, consider me biased. I own shares of Magna Mining. They are a banner sponsor. Assume I might sell or buy at any point in time. So I'm not going to be able to hold everyone's hand all the time. If you're sitting on a good profit now and you don't know why you're in the stock, yeah, I mean, obviously you should sell. Know why you're in. Know what you think your edge is. Know what you think the market is doing wrong. Take responsibility. And for God's sake, see short-term volatility for what it is. On a day with no news, nothing has changed for the company. Absolutely nothing. Price changes all the time. Price changes absolutely all the time. So risk-reward changes all the time. Price-to-value gap changes all the time, every day. But think about the big picture. What is actually the case as you see it? What do you think this company is going to be in a year from now, 2 years from now? Do you think a company is either undervalued or overvalued on any given day? If it's overvalued, it's a sell. If it's undervalued, it's a buy. And investing is all about the future. So if you think you see something in a future, which makes the current price look very cheap. If you're right, you're going to make a lot of money. Or if I mean, you can be right on the case, but some stuff happens anyway. But if you think there's a good possibility that, hey, this is going to be worth a lot more and therefore the pressure on price is going to be higher over the next 1-2 years, that would be a buy. If you think a company is going to be worth less 1 year or 2 years from now relative to current price, that's a sell. Simple as that. And the bigger margins we can have, the better. If I thought Magna was worth this much, and that would account for any future possible upside, like government grants, toll milling, how that would look, what also getting into production, additional acquisitions, drill results, footwall discoveries. If I think base case, risk adjusted, this is how much Magna would be worth, and it would be trading here. That's not really a good opportunity. No, I don't think that's the case. Yeah. Anyway, again, I hope you get something out of this. And again, what has happened is already in the past. We don't care about the past. I don't care about how much I'm up in a stock or down in a stock. All that's left is what price we're paying today and what we expect to happen over the next 1-2 years, which nobody gives a crap about. But if you're like everyone else whose main concern is if a stock's going to be up tomorrow or down tomorrow or next week or whatever, and you can certainly not see through a 20 or 30% correction, you should probably not be in this sector to begin with. Thanks for listening. Bye.